Folks, on Thursday, we get a very important economic number. It is called Consumer Price Index, CPI. Just so you know, that number comes really with four variables. There's headline, core, year on year. There's headline, core, month on month. We will have to look through all of those numbers. That will be market moving, no doubt. We are all hoping that there's confirmation. Headline right now, I believe, is 6.5 is year on year. I think it's 0.1 month on month, and then core.
Yeah.
Core is what is stickier. It's what I've been pointing out. We should all be watching. But let's have this conversation because we got to talk about gold. We got to talk about the Fed, all this stuff with the one and only Dan Bird. How you doing, sir?
Doing well. Good morning.
Good morning.
Fresh off a 2-day seminar from VectorVest, which was amazing, fascinating.
Yeah. So 2 days, we're talking 8-hour days.
Oh yeah.
Just
Yeah.
Dan being a student. I can imagine you in the room, front row, notepad, just
asking questions.
I would expect nothing less. I'd be in the back of the room, probably not paying attention, but
in fact, I met with the CEO of VectorVest, and I was explaining to her the way I use stock charts as well, how I use both of those together. And I kind of showed you guys that, I think, last week when we looked at the dividend stocks, how I can identify them and I can transfer it back to back to stock charts and vice versa.
Nice.
And she was, of course, she's defending VectorVest. She's like, well, you can do charting in VectorVest. I said, yeah, but not anywhere close to what you can do in stock charts. She goes, well, it's interesting because the people from stock charts just called me and they want to have a conversation about partnering.
Yeah.
I said, that would be an amazing platform if you could partner together. She goes, yeah, now just keep in mind, all I want is their charts. Right. I want a way of, using their charts inside of the VectorVest platform.
Sure. Yeah.
I'm like, yeah, that would be great because that's why I use both, because VectorVest doesn't give me what I need on charting and stock charts doesn't give me what I need on fundamentals.
There you go.
So I use both of them together. She goes, would you be willing to do a Zoom meeting with me and my development team and show me how you use stock charts before I have this call with them?
Oh, there you go.
I'm like, yeah, I'd love to do that.
There you go. Well, there you go. Dan Bird always making friends. Well, let's talk about CPI because I think it is a very important number. I think the market or the experts is expecting a lot. 6.5 off of 7.1 for a second month of a decline of 0.6. That's quite a bit.
It is quite a bit, and I'll show you why here in a second. Let me share my screen, and I'll share my newsletter if anyone's interested. If you want to receive it, there's no charge. I do the research anyway for myself, and I just put it all together and send it out to folks. Just send me an email to breakpointtrading@gmail.com, and I'll send you last week's, and I'll put you on the list. And I added some new book recommendations too from these I got from the conference, the VectorVest conference. So I always learn something new whenever I talk to other folks. So
that's cool.
As you should. So in my newsletter, let's go back and look at next week's calendar. And the CPI is forecast for 6.5%. The last one was 7.1. Now, remember, we went from 7.7 to 7.1.
Right.
So that was a 0.6% decrease. And now they're forecasting another 0.6% to 6.5. Will it get there? Well, let's take a look at this. I have some reservations about it, frankly.
Yeah.
So this is a chart that I've shown before I put together that includes the CRB, and the CRB is made up of these components, 19 commodities in agriculture, energy, industrial metals, and precious metals. That's the blue line right here. And I also included gasoline and oil because they're a key part of the economy, and then lumber, of course, what lumber's doing. I don't want to put too many commodities on here because it just would get too crowded.
Yeah.
So the last CPI number that went from 7.7 to 7.1 was for November to December.
Right.
So if you kind of look at this November line right here and follow these commodities over.
Yeah.
You know, the CRB kind of was flat, but the other ones had definite declines.
Yeah,
Gas
no
and oil
question.
went down dramatically. So that's why it went from 7.7 to 7.1
Mm-hmm.
because of these declines. But if you look at December, CRB went sideways, had a nice decline in the beginning of the month, but came right back up again.
Right.
Right. And then gas and oil actually went up slightly from the beginning of the month. Lumber continued to go down.
Okay.
But gas and oil actually had a slight rise versus the November time when they had a significant decline. So we had a 0.6 decline with this. I'm not sure we can get a 0.6 decline again with the way this looks this month.
Yeah, for me, it's really about stuff, right? So there's the commodities components, there's the shipping components. For me, it's going to be all about stuff. I mean, when I say stuff, I mean stuff that's shipped in cardboard boxes,
Right.
clothing, computers, used cars aren't shipped, but it's all the stuff. The only chance we have to get there, because it's not going to be wages. Wages didn't go down 10%, right? Which is,
Right.
7.1 to 6.5 or whatever it is. That's roughly a 10% move. Um, food, I don't think went down. I mean, there's so many things that didn't go, but if there's enough disinflation in stuff, we might get there, but that will be the last time because stuff only makes up 30 some odd percent of inflation. And then there's services, and we're seeing wage
Right.
inflation not really relent up. I mean, ADP private payroll was up 7.1%.
Mm-hmm.
So, yeah, I don't know. 6.5 seems like a hell of an ask, but maybe.
Here's the ADP number, went from 150 to 235.
Yeah, just a blowout. And then wages even higher. I mean, wages were expected
Right.
to be 5 and they went up 7.1.
Yeah. And the jobless claims
Down.
continue to go down. Like
Yeah, we're
they were hoping
flirting
to,
with a record low. The record was 197.
right. And that's kind of reflected in the JOLTS numbers too, which went up.
Oh, dude, the JOLTS numbers. Not only did they go up, but they revised up last month's.
Right.
So yeah, pretty
As
crazy.
job openings. Um, let me show you, we're talking about inflation. Look at this. This is something that I found.
Yeah, eggs, just nuts. Crazy.
So these are all the categories, or some of the categories. Eggs, 49%. This is as of December 12th.
Yeah.
Airfare, butter, lettuce, cereal, pet food. Energy, 13.1.
Mm-hmm.
By the way, if you look down here, all items, there's the 7.1
Right.
from last time.
Yep. It's gonna
Household
be interesting.
products, living room, unleaded gasoline, etc. Then the ones that actually declined, biggest declines were televisions and smartphones.
Mm-hmm.
So now's the time to buy a new phone or new TV.
Yep.
And new vehicles went up slightly, and rent for shelter went up.
Yep.
But it's near the bottom of the list actually.
Mm-hmm.
But used cars and trucks actually declined.
Yeah, and are continuing to decline. Yep.
Right.
Okay.
So that's interesting.
Yeah. Well, what do you think? This is something I had a conversation with my audience on Friday before the jobs number. I was like, this jobs number on Friday is so important to watch because I think it's the number that might make me change my opinion about February 1st. Heading into that number, my opinion was the Fed's going to give us a quarter.
Right.
I was nervous that the jobs number and specifically wages would be higher than expected based on ADP, which was the day before. Thankfully,
right.
Wages came in lighter than expected. So I feel good about my 25 basis February 1st, but I was curious if any of this has changed your opinions.
Nope. I still think it'll be 25. I think it'll be 25 February 1st. It'll be 25 in March. But
Yep.
by the time we get to March, the talk of recession is going to be increasing.
Yeah.
I still think we get a recession, but like we talked about the last time, it's a rolling recession.
Right.
So you can't really use any of these recession indicators that we've used in the past. You can't really say 2 consecutive quarters of GDP.
Yeah, because
negative
exactly.
GDP, because we've already had that.
Yeah.
That's part of the rolling recession. We've already had that part.
Yeah.
Now we're moving forward. Some other parts, manufacturing is starting to decline. So maybe that's the next one.
Yeah.
Jobs is usually the last piece to fall.
Yeah, so I think you're right. I thankfully I've been calling it for quite a while. I think we get a quarter, then a quarter, and they're done.
Yes. Not only are they done, but I think they will still talk tough. They will say, we're done. We got to where we want it to be. Our job is complete. Right. Now we're going to keep it here for a very long time.
We're going to keep it here longer than you expect.
Yeah. So we want to make sure you understand.
Yeah.
We are not pivoting.
Yeah.
We are going to keep it here for much longer than you think that we will.
Totally agree.
And then
awesome.
2 months later, they will start cutting.
Oh, see, now you lost me. Nope. That's where we disagree.
Yeah. We'll see.
I don't think they're going to cut in 23, but maybe.
Yeah, I think they will.
I just don't currently see it.
By the way, cool. on this chart, the CRB, this inflation chart right here, the one thing that I added was I thought, well, what is this level compared to previously? So I drew a horizontal line from where we are right now, January.
Okay.
Takes us back to where the CRB was in March, which is right about the first time the Fed started to cut.
What?
The Fed started cutting in February.
Oh, yeah.
Right?
Yeah.
So the CRB had just started to climb. So we are right back at where it was in March. If you look at gasoline and oil, we are at levels before the first Fed rate hikes. And lumber is way below where it was during the first rate hikes. First rate hikes were right here in February. So all of these numbers basically are right back to where they were at the point where the Fed decided to start raising rates.
Cutting rates.
Raising rates. Fed started to raise rates in February.
Oh, I'm sorry, raising rates. Right.
Yeah.
Right.
Fed started, I think I said cutting rates in the beginning, but I meant raising rates.
Raising rates. Yeah.
I meant raising rates. Right. So they started raising right in through here, but all of these inflation commodities are at the same levels or lower than they were when the Fed began to hike rates.
Yeah, they raised a quarter, then a half, then 4 consecutive 75s.
Yeah, they did the 75s because look, all of this really started spiking and continued to go up.
Yeah. And so they were still buying bonds. They were still in the bond market. But we digress.
Right. That's right. That's true. Yeah. So let's talk about gold for a second.
Please.
I went back on gold 20 years because I've noticed gold starting to climb again.
It is.
And which normally happens when the dollar gets weaker.
Correct.
And the dollar has been getting weaker. So will gold continue? Is gold a good place to be?
Yes.
This is something that I heard from Dr. David Paul at the VectorVest seminar.
Okay.
He's amazing the way that he looks at stuff. He said gold is a very small market. It's tiny compared to bonds and equities.
Oh yeah.
The gold market is tiny.
Right.
He said, but if you look at this chart, this goes back 12 years, back to 2011, when gold got up to 1900, almost 2000.
Yep.
And then slowly went down and then slowly came back up again and then started to decline again. And now it's starting to climb again. If you look at that, that's a beautiful cup and handle pattern.
Oh, yes.
See that?
I do.
So if gold goes up and breaks these highs above 2000, what he said was all of the big investment houses and hedge funds, they're going to start being interested in gold.
Interesting.
And if you get those big players to step into a tiny market,
oh, it'll distort it. Yeah, absolutely. Yep.
Yeah, gold has a potential if it breaks this. Now, this is a very important and very strong resistance level right here. So it could very likely go up and hit this and start back down again. But if it breaks it and closes above it, which is never done, closes above 2000, then that's going to get the attention of a lot of big traders. And that by itself could just push gold much higher.
Oh, for sure. Okay.
So keep that in mind. By the way, this is a monthly chart. So this moves very slowly. But you can look at the momentum indicators down here too, and they're starting to turn up.
Interesting.
On a monthly basis.
Now, so when you look at gold, that's actually the commodity, not the ETF, or do you see them as one and the same?
What I'm looking at here is the commodity. It's actually the spot price of gold.
Got it. Okay.
See up here, continuous contract.
Oh, there it is. Okay.
Gold continuous contract from the CME. But everything else follows this.
Sure.
So you could play GDX, which is an ETF for gold miners. You could play Nugget, NUGT, which represents gold itself. It's an ETF for gold. That's some ways you could play it.
Very cool.
Here's gold compared to the US dollar.
Yes. Yep.
So gold's on the left, the dollar's on the right. This is a weekly chart. So it looked like the dollar was going to rally last week.
Right.
Started climbing back up again. You look up here on the daily chart. The dollar started climbing back up, and then Friday, with that
turned around,
that big rally,
the
dollar went in the opposite direction. And gold is just continuing to rally up.
Okay.
So that I thought was interesting. It'd be interesting to watch gold and see what it does. This is the US dollar. This kind of highlights it right here.
Right. Yeah.
This is a weekly chart. So this last bar right here is for the whole week. You can see that during the week it started down here, it rallied all the way up to here, but then it closed way down here again.
Yeah. Okay.
And you can see the rate of change for the dollar just fell off a cliff.
Yeah.
And dollar and gold together where they crossed, dollar goes down, gold goes up. So they're inversely correlated. And then the 10-year treasury again on Friday just cratered.
Yeah, well, it'd be interesting to see if we have follow through on Monday.
A couple of other things to show you, and one is this. I put this in my newsletter as well.
Yeah, shipping rates. Yep.
There was a guy at the seminar sitting in front of me. We had a conversation, and we talked about the CPI number next week, and he's like, "Oh yeah, we're going to 10%." So what do you mean 10%? 10% on what? He goes 10% on the Fed funds rate. Because I know back in the 70s, early 80s, we got to 18%. He goes, "We're not going that high, but we're going to 10%. I said, I don't think so. I don't think there's any way we get to 10%. I'd be surprised if we get over 5%.
Yeah. Okay.
I didn't have this chart at the time, or the other ones that I just showed you, or I did show him.
I'm curious, what was his logic? Because again, I have people.
You know what his logic was? His logic was, I lived through the 80s, so I know where it's going.
Oh, okay. All right, cool. Got it.
It was a gut feel. A gut feel, and he probably was listening to, either a newsletter that was trying to get him to sign up saying that everything's going to crash soon. And if you want to be saved, he did say that he's been killed in the market because he didn't do anything. He's just a buy and hold, and he just holds things forever.
Well, there you go.
So he was down like 30% this year.
Yeah.
But
there you go. All right.
I added him to my newsletter. I told him about it, and he wanted to get the newsletter. So I actually talked about a lot of these things just kind of for his benefit.
Yeah,
10%. And I put this in there too. But this is the container cost of a container. And you can see here after the COVID, which was COVID started right about here.
Okay.
And then COVID, went through 2020. And then in 21, which is right about here, this is when everything started to spike.
Right.
And I think I'll talk about this in my next chart, but this is a good example of supply and demand and what it does to inflation, and the reason that we have inflation right now.
Yeah.
It's a very different reason than we had it back in the 80s.
Sure.
So right here is where, people started to go back to work and started to travel again, and all of this started spiking.
Well, it's really what happened there, and I was telling people is supply buyers.
Yeah.
Buyers were not getting everything they wanted, so they double and triple ordered. It's
Right.
just
Yes. They double and triple ordered, which made the cost to ship it in a container spike.
exactly shocking.
The top was right here, September of 21. All right. Now, January of 22 is when the market started crashing, which is right about here.
Yep.
But this is the high, and ever since then, it's just fallen off a cliff.
Yeah.
So now it's back to, what's the low here? 21.27.
Yeah.
Right there, which is way back. 21.74 is way back here. So September of 20.
Yeah.
Right during COVID, almost back to pre-COVID levels again.
Almost. Yep.
So that's one reason why inflation is going to continue to come down, among all of the other reasons. But this is a very clear example of why inflation is going to come down as we open up the supply chains and as these costs come down and we normalize inventories, things like that. Everything that's been out of balance because of COVID.
Yeah. Cool.
And then the last one, which really I think highlights that whole idea of supply and demand, is the Baker Hughes oil rig count.
Yeah.
Which is right here is where it's at. So it's at the same level as it was in March of 2020.
Yep.
Right when the pandemic started.
Right as we're shutting everything down. Yep.
Right as the pandemic started, they shut, and all the demand, everybody stayed home and didn't travel, didn't do anything, didn't go anywhere, stayed in their house. So the oil companies started shutting down the rigs because there's no demand.
Easy to shut down, hard to get started.
That's right. It's real easy to shut them down, but it's really difficult to start them back up again.
Yes.
This is a great example of supply and demand 101, economics 101.
Agreed.
So right then, that's when the pandemic started. They shut down all these oil rigs. And then, hey, guess what? We were opening everything up again. People just wanted to travel. They were tired of being in their houses. They wanted to get out. Well, they couldn't open the oil rigs as quickly. Correct. So, of course, the price of oil is going to go up.
Yep.
It can't do anything else.
Yeah, exactly.
And right now, it's kind of leveling off. It's kind of getting flat right here.
Very cool.
So we're almost normalized on this one. We're almost normalized on that one, and we're almost normalized on this one.
Very cool. Well, it's going to be a lot of fun to watch next week. CPI, we're going to be obviously talking together next Sunday. Could you show your newsletter one more time?
Sure. Here we go. If you want to join, just send me an email to breakpointtrading@gmail.com, and I will send you last week's and then add you to the list. And if you get tired of it or you don't like my cartoons anymore, just let me know and I'll take you off.
Yeah. Folks, as we wrap this one
up. By the way, I was late this weekend because I was at the VectorVest seminar, and I have to split up my distribution lists because they're too big now. So I send half of them out on the first day. Usually it's on Saturday and the other half on Sunday. Well, now I've sent half of them today, so the other half's not going to go till tomorrow morning, Monday morning.
Yeah, there you go. Well, folks, do me a favor. If you see the Fed funds rate going to 10%, leave a comment below. I'd love to know why, other than you lived through the 80s.
Or do you think that it will?
Yeah, yeah.
If you think that it's going to go to 10%,
let us know. And let me know why, because I'd love to hear from you. Dan, thank you so very much. You're so awesome to do this each and every week. Take care.
You bet. My pleasure.